Assalamu alaikum. Good part of the day, dear everyone. We finished performance management again in a month, and after finishing the syllabus, we decided to just practice and assess the students on how they performed, how they understood the topics. So there were 20 questions and 60 minutes overall. Let's now analyze the questions one by one. Which of the following is often used to protect internet and intranet from unauthorized access? So there is this term called firewall, which protects the intranet from unauthorized access or people gaining access to the server. So passwords, data encryption, antivirus software all kind of help to keep the file secure, but they cannot protect from unauthorized access. Only firewall can. Secondly, Sean Cole runs a chain of fashion retail stores. A key element is being able to identify customer trends. Okay. So which two are the potential source of big data? So source of big data, firstly, should come from externally, from customer trends, external to the organization. So we should find two sources of data, very big data, which are not Sean Cole's own data. So online video clips of clothes being shared by customers. Oh, this could be one of the sources, because what clothes they share, clips, I mean, according to that, we could identify the trends, customer trends. Daily transactions records from the stores. No, this is an inside information, and big data for customer trends comes from externally. Inventory records, again, this is an internal data. The number and level of discounts, Shonko, again, this is the internal data that Shonko is doing. So to identify customer trends, we need external data, which is the first and this fourth one. Keywords from conversations about fashion and social media in the internet or in the World Wide Web do help. Like these two sources are going to be big data for Shonko to identify customer trends. Third, activity-based costing. What is the cost per machine setup? Let me now change the color of my pen to black to make it more visible. So a lot of people here make the mistake of cost per machine setup. They just divide cost, like the machine setup cost, by this only. So it depends on the number of batches. As you can see, like 400, 500, 400. They divide this by a total of, let's say, 1,300, which is going to be incorrect because this is batch size, which means one batch comprised of 400 units. So if 400 of units of EM consider one batch, then 40,000 units of EM make up 100 batches. So if one batch of TM is made up of 500 units, then 32,000 units of TM is going to be 64 batches. So this divided by this. Again, the same logic applies to this, and we have overall 110 batches of GM. So we totaled the batches and came up with 274 batches. Now we divide this machine setup cost by 274 because its cost driver is number of batches. So when we divide the machine setup cost by the net number of actual batches, then we get this number, $1,200 per batch, per machine setup. Fourth, it's about target costing and closing the cost gap. Okay. What is the value of cost gap? So we find the target cost, and then we find the actual cost, and then identify by how much our actual cost is greater than the target cost. So the target cost is, look, in the last section, the company believes it will be able to sell the product at $200 and profit margin of 25%, which means 25% of this amount is profit, which is like $50, and the other $150 is going to be the cost, target cost now. What about the actual cost? For the actual cost, we add up the individual cost. Direct material, 50 kilograms at $2.50 per kilogram is going to be $125. Labor, so 25% chance an hour and a half, 30% chance 2 hours, and this. So we find the expected number of hours needed for the job. So 1.5 hours with 25% probability, plus 2 hours with 30% probability, and 2.5 hours with 0.45% or 45% probability. Overall, average, like we expect the direct labor to work 2.1 hours. So if labor is paid at $15 per hour, 2.1 hours is going to cost $31.5. Variable overheads are like $8 per labor hour. So 2.1 hours multiplied by 8 is going to be $16.8. When we add up these all three cost figures, our actual cost is going to be 173.3, which is $23.3 above our target cost. And this comprises the cost gap. So we need to decrease the cost by 23.3 in order to achieve target profit. Fifth, okay, what's the life cycle cost per unit? One rule about the life cycle is that for life cycle, we add up all the costs from design to dismantling the product. So we add up all this R&D cost, like 5,000, marketing cost, 588, production cost, 5,200, and disposal cost. When we add up all these, we come up with 41,538. A logical, a reasonable, and a wise PM candidate will look at this figure and think, how can the cost be so low throughout 4 years? Because production usually takes about $1 million of cost. So we need to be careful about this figure. All costs include in 1,000 units. So 250 means $250,000. So when we have this final total cost figure, 41.538, that means not just $45,000, it means $45,538,000. So we need to be careful about that. So life cycle cost per unit is going to be all costs divided by all units. So all costs are 41,538,000 divided by total number of units produced and sold. 3, 16, 24 is going to make up 43,000. So when we divide it, the result is going to be $966. So $966 per unit is the real figure. Don't get confused at this. Do take into account 1,000 units, which are given for the cost. Otherwise, you will come up with an incorrect figure. Otherwise, we would have to divide 41,538 by 43,000, and cost per unit is going to be less than $1, which is going to be incorrect. 6, we are asked to find the throughput accounting ratio. Okay, for 2 decimal places. Fine. So to find throughput accounting ratio, we need to find firstly return per hour, secondly cost per hour, and then divide 1 by 2. Return per hour is selling price, which is we're asked to find only TPAR for product B only. So we look at this now. Selling price 25. To find the return per hour, we subtract only the material cost per unit from selling price, because for throughput accounting, only material costs are deemed to be variable. All other costs are assumed fixed. So 25 selling price, 5 material costs on the numerator, on the denominator, divided by 0.25, because our limiting factor bottleneck is the direct labor hours. So we divide by how much it takes for unit, how much time labor takes per unit. We divide by this and come up with the figure. So return per hour, return per direct labor hour is $80. And to find the cost per hour, we add up all the costs now. Not just product A, but product B as well. Okay, 2,000 units. So $8. All other costs, except for material cost. 8 for direct labor, 19.50 for production overhead. So 27.5 per unit multiplied by 2,000 units. Here it is. And for product B, 10,000 units by 12. So total factory costs are going to be $175,000 divided by total number of limiting factor hours. So we have total of 3,500 labor hours. So we divide by this. So the cost per labor hour is going to be $50. So we divide return per hour by cost per hour to come up with throughput accounting ratio. So we divide 80 by 50. Our throughput is going to be 1.60. It's actually 1.6, but to 2 decimal places, let me just be super clear and super correct and add 10, which doesn't add value, but which conforms to the requirements. 7th question. Okay, so break-even, fine. The markup which needs to be added to marginal cost to allow the product to break even at the budgeted unit. Okay, for the budgeted unit, all we need is break-even point is found by fixed cost divided by contribution per unit. So our contribution is going to be found by selling price, which we don't have any information yet. Selling price less variable costs. So direct material, direct labor, variable overheads are all variable costs. It's total $40. So selling price X less 40. This will give us a contribution. And our budgeted units are 450 units. So when we multiply this by contribution, the number of units, then it should equal to fixed cost to break even, so that all our costs equal to our revenue. So we found X 60, which is the selling price. Now we find the markup. Markup and margin are 2 different things, which usually confuse the candidates. Markup is on the cost. So our cost, variable cost is 40. So we apply markup here. It should equal selling price. So 60 is 50% greater than 40. So 50% greater than the cost, then our markup is 50%. For the next question, okay, coax makes 2 products, Y and Z, and we're given the ratio, constant ratio. What's the break-even revenue for the business? Firstly, let's find the contribution mix. Selling price is 61, variable costs are 42, and our contribution is 19. Selling price 95 with variable cost of 63, we get $32 contribution. So to find contribution mix 4, 2, which means 4 units of Y for every 2 units of Z. 4 units of Y with a contribution of 19 plus 2 units of Z with a contribution of 32, which gives us a total of $140 of contribution mix. Now let's find the sales mix. 4 units of Y with a price of 61, 2 units of Z with a price of 95 is going to give us 434. And then we find the contribution to sales ratio. So contribution 140 divided by sales 434. Contribution to sales ratio is 1.323. So break-even revenue is found by fixed cost divided by contribution to sales ratio. Our fixed cost is going to be here $200,000. When we divide it by the contribution to sales ratio, we get 619,000 something. So the closest we have is $620,000 to the nearest whole number. 49th question. Okay. Annual budget is given for different components. We could produce them in-house with this capacity, or any of the components can be purchased externally. Fine. Okay, in order to optimize the financial return, that means if we want to optimize financial return, we want to minimize the cost. So we do the cost benefit analysis on the external purchase. Like how much extra should we pay if we are going from subcontractor or external supplier? So let's do this table, extra cost of buying externally. So additional cost of external purchase like 40, 31, 16, 33. Where is it? How did you find this? 14, 40, 31. It's actually found by subtracting this variable cost of producing in-house, subtracting this number from external purchase. 60 less 20, which gives us 40 extra cost of purchase, and 31 comes from 46 less 15, and the same logic applies. These are the extra costs for every component. Hours saved, that means how much hours, like how many hours would it take if we produce it in-house? So 3, 2, 1, 1.5. It's written here. Extra cost per hour saved. So for every 3 hours we are saving, or for every hour of W direct labor, which goes to W, we're saving $13.3. For every X, we're saving 15.5 of $15.5 of X, $16 per hour of producing Y. This is the extra cost per hour saved. So what we're going to do, we're going to minimize the cost. So we're incurring the least cost, external cost, if we are buying W from external supplier first, and then 15.5 less than X. And lastly, it's not wise to buy component Z from abroad, because for every Z, we need to pay $22, which is way more expensive than all other components. So that means, in order to optimize financial return, which component should be purchased externally? Which one do you think it is now? Which one do you think it is now? It's easy now. Okay. Here, we also ranked here. and this is the answer to this question. The least cost comes from W, so we need to buy this first. So the answer is going to be W. Because if we buy W from external supplier, we're going to incur the least cost. This is a logic. For any question, outsourcing or making in-house, you need to apply this logic. How much extra should you pay if you buy externally? And then decide. And for the least cost externally is going to be the one that you have to purchase. For the 10th question, which is a very good one, relevant cost. What's the relevant cost of diverting labor from existing work to perform the special job for the customer? Relevant cost of labor is made up of two costs. Firstly, this is the labor cost for the product, for the new project. And then if labor is working at full capacity, lost contribution. So what's relevant is that for the new project, how much should we pay for the labor? And then how much are we losing? If our labor is working on the new project, how much are we losing? Because they are not producing what they used to do before this project. So labor cost, okay. Selling price, okay. Direct labor 2 hours, the $20 for 2 hours, that means $10 per hour. Variable overheads 2 hours, so $4 for 2 hours, then $2 per hour. Look, here a very important distinction. Labor goes in line with the variable overheads. So if we are taking direct labor away from current job, then this should also include variable overheads too. The new job requires 20 hours of direct labor time. So 20 hours, $10 per hour for 20 hours is going to be $200. Then also again, variable cost, $2 per hour for 20 hours is going to be $40. And then we found the labor cost now. Now about loss contribution. How much are we losing? Loss contribution is the current contribution per hour per labor hour. 80 selling price, direct material, labor, variable overheads. When we subtract these variable costs, so for contribution, please be careful not to subtract fixed cost. When we subtract variable cost from selling price, we come up with 46, which is a contribution. But because each unit requires 2 hours of labor, for every labor hour, we get $23 of contribution, which means if we are taking labor away, we're losing for every hour $23. For every hour of labor, we're losing contribution of $23. So for 20 hours with $23 per hour, we're losing $460. This total is going to be relevant cost of diverting labor from its existing work. 240 something, $700. That's going to be the direct relevant cost for labor.